Hello, everyone. In today's lecture, we're going to talk about bond pricing. And I think you're going to find it's pretty easy to do. You already have the skills to do this, but it will be very powerful for you as far as you're building your toolkit, your financial toolkit. Time value of money, of course, is very foundational to all of that. Bond pricing is really an extension of that. Now, remember, just as a little recap before we get into the couple of scenarios here with bond pricing, what is a bond? As you probably have figured out from the reading, a bond is usually issued from a company or an organization to gain capital, which is money, money to do stuff with. And it's kind of a way to go directly to the people to make a loan. You go directly to, you skip the middleman, kind of skip the banks in a way, to get a loan directly from other companies or from individuals like you or I. But there is a problem inherent with that, or a situation that develops. Not really a problem, but let's say when a company issues a bond, it's has a face value on it, a coupon rate. These things are fixed, has a par value. These things are all fixed at the time of the bond is issued. And they're based on the current market interest rates at the time. And as you probably have figured out from the readings, the calculation of that interest rate incorporates a lot of things. The risk of the entity issuing the bond. Do they have great credit quality or are they a little shaky? If they're a little shaky, they're going to have to pay people a little bit more through an interest rate. But all of these will be fixed at the time the bond is issued. But as we all know by listening to radio or TV or watching the internet, the economy is rarely fixed. It's constantly in flux. Interest rates are moving. So how does that impact a bond? Let's say you have a bond and all of a sudden interest rates go down. After you've owned it for a few years, you've been happy, but interest rates start going through the basement like they have done in the past 8 years. This is the lowest I've seen interest rates in my life, and probably my guess it will be the lowest that you'll see them in your life, and you'll go back to the good old days of the teens and how low interest rates were. But everything's a cycle, and I guess I'm afraid of what the opposite end of the cycle is. We may be faced with another situation like we had in the late 70s, where we had double-digit interest rates. But let's hope not. But anyhow, but rates always constantly change, and that impacts the value of the bond. If you were to go buy a bond with a fixed interest rate on there, someone has already owned a bond. Let's say they want to sell it. I've owned it for 2 years and now I want to get rid of it. Well, that bond is going to be priced in the market. It's going to come up with a price. And how do you come up with the price? Well, there's actually a formula that comes up that you can use to actually figure out what the fair price of that bond will be. So you're going to be able to work you can blow people's mind and that you can calculate the value of a bond in various interest rate situations. And that's what we're going to talk about today. All right, so let's take a look at a basic example here. And with this, let's say we have a bond that has 20 years to maturity. Again, that's going to be something fixed at time of issuance. It's a 20-year, fixed maturity. We're not going to talk about call options or anything like that. Has a coupon rate of 10%. Again, that'll be stamped right on the bond. We will pay 10%. We're going to do annual payments to keep it simple. And we're going to have a par value of 1,000, which is kind of an industry standard. Again, that's going to be $1,000. That is going to be returned back to you at the maturity date. It is the face value of the bond, if you will. Now, time goes by. Let's say 4 years have gone by since the bond was issued. Maybe you acquired the bond right at issuance. 4 years have gone by, and interest rates have fallen. Okay, for various reasons. Who knows why? It could be the economy they're trying to stimulate the economy. So the Fed, you might hear this, the Fed cuts interest rates to stimulate the economy. That's all factored into this. Just so happens right now the Fed is starting to creep up interest rates. So if you start hearing about that, because again, we're kind of at an all-time low. So the Fed is starting to creep interest rates back up again. But let's say interest rates have fallen to 5%, or I should say the required rate of return for a similar investment of similar risk has interest rate has fallen to 5%, which it means in general probably something with the economy. Interest rate money is cheaper. Interest rates have gone down. What is the value? What is the bond's value? You're probably thinking, how am I going to solve this? Well, it's actually not very difficult at all. We've got all the numbers that we need there. We're going to use our handy dandy arachnoid.com finance calculator, which I gave you the URL in module 1. So hopefully you've got that URL saved in your quick links and your favorites, and you're going back to that. Let's break this down. So what we need to do is just enter our inputs. So if you actually were totally stymied, you could always play around and enter these inputs. And that's kind of what we're going to do. Well, the present value is what we're solving for. So hopefully you can figure that part out. Whenever you see what is the bond's value, value as of when, well, a value as of right now. We've projected ourselves 4 years in the future, 4 years in the future. So it's the kind of the right now of again in 4 years. So we don't know. That's what we're finding for. All right, well, let's move on to future value. Do we know what future value is? Well, we sure do. Future value is listed right there. It's going to be $1,000. That's how much will be given back to you at the end of the 20 years. So let's put in our 1,000. Next will be number of periods. Well, this is where it might trick you up, so be careful. Number of periods. Well, you might look up here and go, oh yeah, it's 20 years to maturity. Well, remember, 4 years have transpired, so we only have 16 periods left. So just put a 16 in there. So be careful about that. Make sure you're looking at the number of periods remaining when you're doing this. How many more payments are you going to basically receive from the company that those interest rate payments? And we've got 16 left because 4 of them have already expired, already gone by. Now the initial amount of payment, well, what's the payments? Well, that you have to do a little bit of math, okay? So we go back up to this original fixed information, the information that's basically stamped right on the bond. 10% coupon rate with a par value of 1,000. Do you know what the interest payment would be on that every year? Think about it. Well, it's 10% of 1,000. Literally, the company will mail you a check for $100 every year, as long as you're the registered owner of that bond. So we know what the payment is. That's going to be 100. So we're just going to leave that right in there. That's our default payment anyway, is 100. That kind of shows up in the Arachnoid calculator, but we'll leave that as 100. Now I know that the sign issue is, should I put a negative or a positive in there? Well, let's just put positives all the way across. Again, you don't let it throw you necessarily when you see a negative at the end. You kind of can intuitively answer the question if you messed up on the signs anywhere. And I'll show you by, hopefully we come out with the answer on this. All right, so we know we know the amount of payment's going to be 100. Interest rate. Okay, what's the interest rate? Well, we're not using the coupon rate because the new required rate of return on that type of bond has now fallen to 5%. So we want to put 5% in here. All right, I think we got it all in there. And now we just hit compute. And boom, there we go. The value of the bond right now, or I guess in the now of 4 years from now, is $1,541 and change. Now, that hopefully wasn't too bad for you. Pretty easy stuff, right? And you've been able to calculate what the value of that bond would mean. So what that means is, like, if you were to go out, you go to E-Trade or you go to Ameritrade or you go to your stockbroker and you say, I want to buy that bond. Well, he says, okay, great. You can buy that bond. It's got 16 years left on maturity. It pays a coupon rate of 10%. It's going to cost you $1,541. You give them that, boom, you get your bond, and you get your payments. What that does is that if you notice that it's $1,541, the par value is 1,000. Boy, it's a lot more expensive than what it says on the face of the bond. Why is that? Why is it more expensive? Think about it for a moment. It's selling at what they call a premium because it has a higher interest rate than what's really required. Now, what the market, the market, when I the market, any kind of exchange area, um, they do not like gaps. They don't like what's called arbitrage, where areas where you can make money for nothing. So usually those gaps are filled in very quickly, and there's a certain equilibrium that will happen to something to make it, I guess, to make it fair. It's just the way free markets work. It's kind of cool. So that bond, its price would ratchet up to $1,500. So the overall net effect for you as the owner of the bond, your overall net effect on that is you're still getting 5%. Even though your coupons are at 10, you had to pay a little bit more to purchase it at that point. So your overall effect is 10. I guess you can't pull one over on the market. If the interest rate is 5% for that type of investment, the required rate of return is 5% on the investment. But you look at the bond and it pays 10, you're thinking, oh my God, this is great. I'm going to buy this and no one's going to know. Trust me, the market knows, and it will, through supply and demand, will naturally bring that up to $1,541 for the value of that. Of course, they have computers and stuff that do that now, but that's what will happen. You can very rarely find. That's what's called arbitrage. If you did find a bond that was paying that you could only pay $1,000 for, that paid 10%, yet the required rate of return is only 5, gosh, you would mortgage your house and buy as many of those bonds as possible because you've just found a arbitrage opportunity in the market. Again, those really don't exist, and if they do, they're usually illegal. So, so there you go. You have found the value of a bond after an interest rate decrease has happened. Now, here's something else to kind of a little memory mnemonic, if you will, or a little visual. I'll give you my visual back from my stockbroker days. And that was, if interest rates go down, your bond prices are going to go up, and vice versa. So again, if interest rates go down, bond prices go up. If interest rates go up, your bond prices are going to go down. There's always that inverse relationship on that. So here's another kind of big picture thought too. If you're holding a portfolio of fixed rate bonds, in there, a large percentage, and you're facing an increasing interest rate environment, you're going to see your portfolio values go down over time. Um, and that can be, especially troubling, especially for usually as you get older, the percentage of bonds that you hold in your um, retirement accounts, it's usually higher because they're more stable. But if we have some runaway inflation and runaway interest rates, your portfolio, if you have a good portfolio manager, they can't swap those bonds out quick enough, and that's where you can see some actual almost stock market like depreciation, some falls in the value of your portfolio. So there's a little bit about bonds. So you learned a couple things, right? You've learned the inverse relationship on interest rates and value for a bond. You've learned that if the coupon rate is higher than the required rate of return, that bond is selling at a premium. If the coupon rate is the opposite, if the coupon rate is lower than the required rate of return, what's going to happen there? It's going to be sold at a discount. So you've learned a couple of concepts there, and you've learned how to value a bond in a environment of changing interest rates. So some pretty powerful techniques. Let's run through one more example after this one. Okay, so let's take a look at that bond under the opposite interest rate environment. We got our old buddy here, the 20-year to maturity. Again, that's going to be stamped right on the bond, 10% coupon rate. Par value is 1,000. But now suppose after 4 years has gone by, rates have increased to 15%. What is the value of the bond? Now you know how to do your little thumbs. Remember I showed you? All right, so do your little thumbs right now. All right, so your coupon rate is 10 and interest rates have increased, right? So increasing rates, what's it doing to bond value? Thumb goes up. All right, the other thumb goes down. So we should expect the bond to be sold at a discount. Well, let's see if that is absolutely true. Let's take a look here. All right, we're going to go back to our old buddy calculator here. So far, I'm really liking this calculator. It's taking care of everything that we need. Again, these are the default values that are in here. Present value, that's what we need to calculate. The future value, well, we know that's going to stay at par, which is 1,000. Number of periods, that's the number of periods left, and we've got 16. Payment, well, that's going to still stay at 100. We'll just, oh, it does that all the time. Goes to that calculator. Okay, or to that dictionary. Let's put in 100. Remember how to calculate that payment. It's simply the coupon rate of the par value, 10% of 1,000. Hopefully, you can figure out what 10% of 1,000 is. Or if I gave you 7% of 1,000, you could easily calculate that, right? Good. Then the interest rate, the IR, or the I, what would that be? Well, it's not the 10, it's the new required rate of return, which is 15. Okay? Let's cross our fingers and hope we've done this right and see what happens. Boom. All right. So you can see here that the value of the bond would be $702.29. And it is indeed selling at a discount because the interest rate is the required rate of return in the market for similar investments is paying, or bonds is paying 15%. Why would you want to buy a 10% dog, right? It's a dog, it's 10%. I can go get 15% in a second. Well, make it more attractive for me. Well, that's how the market makes it more attractive for you. You take the price and go, oh, I'll tell you what, will you take 1,000? No, I won't take 1,000. I don't make enough. How about 800? No. How about 700? All right. Yeah, I'll take it for $700 a bond. At that point, your required rate of return on that becomes 15%, or the rate of return becomes 15% because the required rate of return in the market for similar investments is 15%. So there you go. Not very hard. They can look really confusing when you look at them initially, but hopefully this walkthrough has helped you. With the homework assignments, this should be relatively easy for you with any kind of bond pricing that you might see. As you can see here, you can probably knock these out in less than a minute or two, as long as you kind of be careful. The thing that gets students most is usually the number of periods. They see 20 years maturity and they think back to the old, future value lump sums and what we did in module 1, and they plug that in. Remember, if time has gone by, you need to subtract that time off. In this case, 4 years have gone by. All right. Well, I hope this lecture on bond pricing has helped you understand this very powerful tool. Again, this is something you can impress your friends and neighbors with on this skill, because it's something that probably only 2 or 3% of the population knows how to do. They hear about bond pricing all the time. You hear about stock market interest rate fluctuations, etc. You now have a very powerful and fundamental skill that you can add to your financial toolkit.